Take a moment. Close your eyes, if you can. And just feel it. That knot in your stomach. That racing thought at 3 a.m. That quiet whisper of shame or inadequacy that creeps in when you think about your finances. Does the word debt feel like a heavy, invisible chain around your ankle, holding you back from the life you truly want to live? You are not alone. Not by a long shot. For millions, debt isn't just a line item on a statement, it's a pervasive, relentless source of stress, anxiety, and even physical discomfort. It strains relationships, impacts sleep, and can make you feel utterly helpless. In fact, debt reduction is the #1 financial priority for Americans right now, and the mental toll of financial stress is a growing crisis. But what if I told you that breaking free isn't just about crunching numbers or cutting expenses? What if the real battle isn't in your bank account, but in your mind? Welcome to the Psychology of Debt, Breaking Free from Financial Stress. This isn't just another book on budgeting or debt consolidation. While we will absolutely equip you with powerful, actionable strategies to tackle every type of debt, from credit cards and student loans to medical bills and those sneaky, buy now, pay later, traps, our journey goes deeper. Much deeper. We're going to uncover the hidden psychological forces that keep you trapped in the debt cycle. We'll explore the limiting beliefs about money you might not even know you have, and expose the subtle behavioral biases that lead to impulsive decisions and financial anxiety. You'll learn how to build a resilient money mindset, transforming fear into empowerment, and scarcity into abundance. Imagine waking up without that financial knot in your stomach. Imagine making confident money decisions, free from the whispers of guilt or inadequacy. Imagine a future where your finances are a source of peace, not panic. That's the freedom this audiobook promises. This is your blueprint to not just paying off debt, but truly breaking free from its psychological grip. It's time to reclaim your peace of mind, your relationships, and your future. Are you ready to begin your journey to lasting financial freedom? Let's start.
If you're finding value in this journey and are ready to break free from financial stress, please take a moment to hit that like button, subscribe to the channel, and share this audiobook with anyone you know who could benefit from its message. Your support helps us reach more people who are ready to transform their relationship with money. Now, let's dive into Chapter 1.
Chapter 1, The Invisible Chains, How Debt Affects Your Mind. Imagine, for a moment, a weight. Not a physical weight you can see or touch, but something that presses down on your chest, tightens your jaw, and keeps your mind racing long after the lights are out. This is the invisible chain of debt. It's a burden that extends far beyond the numbers on a statement, seeping into every corner of your life, affecting your peace, your health, and your relationships. You might feel it as a persistent, low-level hum of worry, or perhaps as a sudden, sharp pang of anxiety when an unexpected bill arrives. Studies have consistently shown that individuals struggling with debt are significantly more prone to experiencing depression and anxiety. This isn't just a fleeting feeling, it can manifest physically, leading to chronic headaches, a profound lack of quality sleep, and even an inability to focus or function effectively in your daily life. The constant pressure of financial obligations and the looming anxiety of meeting payments can profoundly impact your stress levels, sleep patterns, and overall mood. Beyond your personal well-being, these invisible chains often stretch to impact your most important connections. Debt can create significant tension and strain within relationships, affecting how you communicate with loved ones and eroding emotional well-being. The stress of financial burdens can lead to increased family tension and even strain friendships, making conversations about money feel like walking on eggshells. And then there are the quieter, more insidious feelings, shame, guilt, and a deep sense of inadequacy. It's easy to feel embarrassed or ashamed about your financial circumstances, especially when debt feels overwhelming. These feelings can lead to low self-esteem and a general sense of helplessness, creating a vicious cycle where the emotional burden makes it even harder to take the necessary steps to break free. You might find yourself avoiding phone calls from unknown numbers, ignoring letters from creditors, or simply trying to avoid discussing money altogether. This avoidance, while seemingly a coping mechanism, often perpetuates the problem, deepening the sense of being trapped. But here's the crucial truth: recognizing these impacts is the first, most powerful step towards liberation. This isn't about blaming yourself, it's about understanding the profound psychological landscape of debt. When we acknowledge how deeply debt affects our minds, our bodies, and our relationships, we can begin to approach it not just as a financial problem, but as a journey towards holistic well-being. We're going to frame this process as your debt-to-freedom journey. It's a transformative path that moves beyond merely paying off balances to reclaiming your peace of mind, your confidence, and your ability to focus on what truly matters. The sense of accomplishment that comes from seeing your debt vanish is, as many have found, truly priceless. Before we dive into the practicalities, I invite you to take a moment and reflect on your own money story. How did you grow up viewing money? What financial habits did you pick up from your parents, friends, or society? Do you spend impulsively? Do you avoid talking about finances? Often, our current financial decisions are shaped by beliefs formed long ago, sometimes based on a perceived lack rather than reality. Recognizing these patterns is the foundational step toward transforming your financial belief system and making smarter choices for your personal finance. In the next chapter, we'll delve deeper into these underlying beliefs and biases, unmasking the psychological traps that often keep us in the debt cycle. Understanding them is key to dismantling them, one by one. Chapter 2: Unmasking Your Money Mindset, Limiting Beliefs and Biases. In our last chapter, we explored the very real, often invisible, weight of debt, how it impacts our mental health, relationships, and overall well-being. Now, we're going to turn the lens inward, because to truly break free, we must first understand the silent architect of our financial decisions, our money mindset. So, what exactly is a money mindset? It's the unique set of beliefs, attitudes, and experiences you hold about money. Think of it as the operating system running in the background of your financial life. It's shaped not just by your personal experiences, but profoundly by how you grew up, the financial habits you observed in your family, and even broader societal messages. You might be surprised to realize how deeply ingrained some of these views are, influencing whether you spend impulsively, avoid financial discussions, or feel a constant sense of lack. Many of us carry what are called limiting beliefs about money. These are notions that, while feeling true, are actually just beliefs, not reality. Perhaps you've thought, "I'll never have enough money," or "only people born into wealth can be financially successful." These are incredibly common. In fact, over 60% of people admit to holding negative beliefs about money. These beliefs can subtly, yet powerfully, sabotage your efforts to get out of debt. They can make you feel unworthy of financial success or convince you that your income has a cap, even when opportunities for growth exist. The first step to releasing these invisible shackles is simply recognizing them for what they are: beliefs, not unchangeable truths. This brings us to a fascinating field called behavioral finance. Unlike traditional finance, which often assumes we're perfectly rational beings making logical financial decisions, behavioral finance recognizes that human psychology plays a massive role. It acknowledges that our financial behaviors are frequently influenced by biases, heuristics, mental shortcuts, and even irrational thinking. Often, we're completely unaware of these underlying biases at work. Let's unmask some of the key behavioral biases that often contribute to debt and make it harder to break free. Loss aversion. This is a powerful bias where we feel the pain of a loss far more intensely than the pleasure of an equivalent gain. For instance, losing $100 feels worse than gaining $100 feels good. In the context of debt, this can make us incredibly reluctant to sell an asset, even if it's depreciating, or to make a difficult financial decision that feels like a loss in the short term, even if it leads to long-term gain. We might cling to a bad investment or avoid consolidating debt if it means acknowledging a past financial mistake. Hyperbolic discounting, or present bias. This is the tendency to prioritize immediate rewards over future rewards, even when the future payoff might be greater. Think about that impulse purchase on a credit card. The immediate gratification of having the item now outweighs the future pain of paying interest later. This bias is a major fuel for credit card debt and the growing popularity of buy now, pay later services, where the immediate convenience masks the long-term cost. Mental accounting. This bias describes our tendency to organize, evaluate, and monitor our finances by segregating money into different mental pots. For example, you might have a savings account growing slowly while simultaneously carrying a large, high-interest credit card balance. Rationally, you should pay down the high-interest debt first, but mentally, you've categorized that savings money differently, making it hard to see the optimal decision across your entire financial picture. Emotional gap. Our emotions can have an oversized impact on financial decisions. When we're feeling happy, we might take on more risk. When we're sad or stressed, we might avoid making any financial decisions at all. Feelings of anger, shame, or even excitement can trigger poor choices. That impulsive purchase we discussed earlier? It's often driven by emotions like boredom, stress, or a feeling that we deserve something, providing temporary relief but leading to long-term financial strain. Confirmation bias and herd mentality. Confirmation bias is our tendency to seek out information that confirms what we already believe, while ignoring anything that contradicts it. Herd mentality, on the other hand, is the tendency to follow the crowd, even when we suspect the crowd might be wrong. This is often driven by the fear of missing out, FOMO. On social media, for instance, you might see others seemingly achieving financial success in a certain way, and without doing your own research, you jump on the bandwagon, even if it's not right for your situation. These psychological traps are powerful. They contribute to accumulating debt by making immediate gratification seem more appealing, by clouding our judgment with emotions, and by preventing us from seeing our financial situation clearly. They make us struggle with debt by fostering avoidance, shame, and a reluctance to make the difficult but necessary choices. The good news is, once you're aware of these biases, you gain immense power. You can start to recognize when they're influencing your decisions and begin to consciously counteract them. This awareness is your first piece of psychological armor in your journey to financial freedom. In our next chapter, we'll dive into the very first, non-negotiable step to breaking free, stopping the cycle of borrowing and committing to a new financial path. Chapter 3, The Impulse Trap, Why We Spend When We Shouldn't. In our last chapter, we began to peel back the layers of our money mindset, revealing how deeply ingrained beliefs and subtle psychological biases can steer our financial ship, often without us even realizing it. Now, let's confront one of the most common and powerful forces that can lead us into debt, the impulse trap. This is about understanding why we spend when we know, deep down, we probably shouldn't. Have you ever found yourself making a purchase you didn't plan, driven by a sudden urge or a fleeting emotion? Perhaps you were feeling bored, stressed, sad, or even overly excited. This is emotional spending, and it's incredibly common. In fact, research indicates that a significant majority of people, 62%, admit to making purchases based on emotions rather than genuine necessity. These purchases often provide a temporary sense of relief or a fleeting high, a quick fix for an underlying emotional state. But as we know, that temporary relief often sets a course for long-term financial strain and unmanageable debt loads. Sometimes, this impulse is fueled by what I call the deserve it mentality. After a long, hard week, or a particularly challenging period, you might hear a little voice in your head saying, "You've worked hard, you deserve this." Or perhaps you feel deprived, seeing others enjoy certain lifestyles or experiences, and you convince yourself that you're missing out. This feeling of deprivation, or a sense that you're owed a certain lifestyle, can lead to overspending, even when you don't truly have the financial means. It's a powerful psychological trigger that can override rational financial planning. And then there's the alluring, almost deceptive, role of credit. Credit cards, and increasingly, buy now, pay later, BNPL, services, make spending feel less painful in the moment. When you swipe a card or click pay in 4 installments, the immediate gratification of acquiring the item outweighs the future pain of paying for it, often with interest. This is a classic example of hyperbolic discounting, or present bias, where we prioritize immediate rewards over future consequences. The rise of BNPL services, especially among younger generations, is a fascinating illustration of this. Many consumers, particularly Gen Z and millennials, are credit skeptical and actively try to avoid traditional credit cards due to the perceived stigma of debt. However, BNPL services offer a seemingly safer alternative, allowing them to make purchases with debit cards and pay over time, often without realizing they are still incurring a form of debt. The convenience and the feeling of avoiding real credit can mask the true cost and the potential for accumulating multiple, smaller debts that become difficult to track and manage. The impulse trap is powerful because it taps into our emotions and our desire for immediate satisfaction. It makes us overlook the long-term consequences for short-term comfort or pleasure. So, how do you begin to disarm this trap? The first step, as with all psychological insights, is recognition. I encourage you to become a detective of your own spending habits. Keep a spending journal. For the next week or two, don't just track what you spend, but how you feel when you spend it. Were you bored? Stressed? Celebrating? Trying to keep up with friends? Identify your triggers. What situations, emotions, or even advertisements tend to spark an impulsive urge to spend? Is it scrolling social media? A bad day at work? A sale notification? Pause before purchase. Before you click, buy, or hand over your card, take a deliberate pause. Ask yourself, am I buying this out of genuine need or desire, or is an emotion driving this? Can I truly afford this right now, without incurring new debt? What is the long-term cost of this purchase? By recognizing your patterns and understanding the psychological forces at play, you begin to build a crucial defense against the impulse trap. This awareness is the foundation for making conscious, intentional financial decisions, rather than being swept away by fleeting emotions. In our next chapter, we'll take this awareness and turn it into action, focusing on the absolute first, non-negotiable step to truly breaking free from debt, stopping the cycle of borrowing. Chapter 4, The First Step, No More Borrowing. We've spent time understanding the invisible chains of debt and the psychological traps that often lead us into it. Now, it's time to talk about action. And the very first, non-negotiable step on your debt-to-freedom journey is deceptively simple, yet profoundly powerful: no more borrowing. You might think this goes without saying, but it needs to be said, clearly and unequivocally. The absolute first step in getting out of debt is to stop incurring new debt. This means putting a hard stop to using credit cards for purchases you can't immediately pay off, avoiding new personal loans, and being extremely cautious with buy now, pay later services. Every new dollar borrowed, no matter how small, adds another link to the chain you're trying to break. This commitment requires a fundamental shift, a commitment to cash. For discretionary purchases, those wants rather than needs, limit your spending to only what you have available in cash. This might feel restrictive at first, especially if you're used to the ease of swiping a card. But this practice forces you to confront the true cost of your purchases in real time. When you see the cash leave your wallet, or watch your debit card balance decrease, it creates a much stronger psychological connection to your spending than the abstract numbers on a credit statement. Breaking the credit cycle is crucial. If you've been relying on credit cards to bridge gaps or fund desires, it's time to find alternatives. This might mean pausing non-essential spending altogether for a period, or finding creative ways to earn extra income to cover immediate needs. For those accustomed to the convenience of buy now, pay later, BNPL, services, remember that while they might feel different from traditional credit, they are still a form of debt. The goal here is to consciously choose to live within your current means, even if it feels uncomfortable initially. This isn't about deprivation, it's about empowerment. This brings us to a vital mindset shift, shifting from scarcity to abundance. When you're in debt, it's incredibly easy to fall into a scarcity mindset, the constant fear of not having enough money, time, or resources. This fear can keep you stuck in a cycle of lack, making you feel like you always need to borrow more. But breaking free requires cultivating a mindset that believes in having enough and focuses on gratitude for your current resources, rather than constant fear of lack. This isn't about ignoring your financial reality, it's about reframing it. Instead of dwelling on what you don't have, acknowledge and appreciate what you do have. Practicing gratitude for the money you possess, no matter how little it feels, can begin to shift your entire belief system. It might sound unusual, but even simple daily affirmations, like "more money is on the way," can help keep your focus on opportunities rather than perceived lack. This shift in perspective can make your financial decisions feel lighter and more intentional, impacting both your life and your bank account in a big way. The "no more borrowing" rule is your declaration of independence. It's a powerful statement to yourself that you are taking control. It's the foundation upon which all other debt repayment strategies will be built. Without this commitment, you'll constantly be trying to fill a bucket with a hole in the bottom. In the next chapter, we'll build on this foundation by exploring how to cultivate a powerful growth mindset, believing in your financial potential and setting clear, inspiring goals for your debt-free future. Chapter 5: Cultivating a Growth Mindset, Believing in Your Financial Potential. In our last chapter, we made a powerful commitment: no more borrowing. That decision, simple as it sounds, is a monumental first step. But to truly propel yourself forward on this debt-to-freedom journey, you need more than just a commitment to action, you need a profound belief in your own capacity for change. This is where cultivating a growth mindset comes in. You might be thinking, my financial situation is just my reality. It is what it is. But that's a limiting belief. The truth is, your financial situation can improve, no matter where you are today. This is the core of a growth mindset in finance, believing that your success has no ceiling, that your financial intelligence can grow, and that your circumstances are not fixed. Think of entrepreneurs who started with nothing and built empires. Their success wasn't just about luck, but about their unwavering belief in their ability to learn, adapt, and grow. Adopting a growth mindset means seeing setbacks not as failures, but as invaluable learning opportunities. Did a budget not work out perfectly? That's not a sign you're bad with money, it's data telling you to adjust your approach. Did an unexpected expense derail your debt payment for a month? That's a chance to reassess your emergency fund or find a new income stream, not a reason to give up. Every challenge becomes a stepping stone, not a stumbling block. So, how do we begin to cultivate this powerful belief? First, by setting clear, inspiring financial goals. Don't just say, "I want to get out of debt." Make it specific, measurable, achievable, relevant, and time-bound. For example, I will pay off my $10,000 credit card debt by December 31st of next year. Or, I will reduce my student loan principal by $5,000 in the next 12 months. These aren't just numbers, they are milestones on your path to freedom. Write them down, speak them aloud, and keep them visible. These goals become your North Star, guiding your decisions and fueling your motivation. Next, we harness the incredible power of visualization. Just like athletes mentally rehearse their wins before a big game, you can do the same with your financial success. Close your eyes and vividly picture your checking account growing. See your debt balances shrinking to zero. Imagine the feeling of ease and confidence you'll have when you're debt-free. What does that freedom look like? What will you do with the money you once sent to creditors? How will your relationships improve? The more you practice this, the more motivated you'll be to take real, tangible steps toward that vision. This isn't just daydreaming, it's sending a powerful signal to your subconscious mind, aligning your energy with your financial aspirations and backing it up with action. Finally, remember that every single step you take, no matter how small, feeds into your personal and financial growth. Whether it's learning more about managing money, finding ways to increase your income, or simply sticking to your "no more borrowing" rule, each action builds momentum. It might seem daunting initially, but when you start small and think big, it all adds up. Every payment gets you closer to your goal of being debt-free. By embracing a growth mindset, setting clear goals, and visualizing your success, you're not just hoping for a better financial future, you're actively creating it. You're building the inner strength and belief system that will make your debt-to-freedom journey not just possible, but inevitable. In our next chapter, we'll delve even deeper into building your psychological armor, equipping you with specific strategies to counteract those sneaky behavioral biases we discussed earlier. Chapter 6: Building Your Psychological Armor, Counteracting Biases. In our previous chapters, we've explored the profound emotional weight of debt and begun to unmask the hidden influences of our money mindset and the impulse trap. You've committed to stopping new borrowing and started cultivating a growth mindset, believing in your financial potential. Now, it's time to equip you with your most powerful defense, building your psychological armor against the very biases that can derail your financial progress. Remember, behavioral finance teaches us that we're not always perfectly rational when it comes to money. Our decisions are often swayed by emotions, mental shortcuts, and deeply ingrained biases, often without us even realizing it. The first, and arguably most crucial, step in counteracting these biases is simple: awareness is key. You can't fight what you don't see. By understanding these common psychological tendencies, you gain the power to recognize them in yourself and choose a different path. Let's revisit some of these biases and arm you with strategies to combat them. Loss aversion. This is the powerful tendency to feel the pain of a loss much more intensely than the pleasure of an equivalent gain. For someone in debt, this might manifest as a reluctance to sell an asset, even if it's depreciating, or to make a difficult but necessary financial cut because it feels like a loss. Your armor: to combat loss aversion, focus on the gain of financial freedom. Instead of seeing a budget cut as losing a coffee, reframe it as gaining progress towards a debt-free life. Visualize the long-term benefits of your actions, not just the short-term sacrifices. Remind yourself that a temporary loss of discretionary spending leads to the immense gain of peace of mind and financial security. FOMO, fear of missing out, and herd mentality. This bias drives us to follow the crowd, to jump on popular trends, or to make impulsive decisions because we fear being left behind or missing out on a perceived opportunity. On social media, this can be particularly potent, as you see others seemingly achieving financial success or enjoying experiences you feel you're missing. Your armor: before jumping on any financial bandwagon, pause and do your own research. Ask yourself, does this align with my financial goals and my debt repayment plan? Am I making this decision because it's right for me, or because everyone else is doing it? Remember, true financial success is built on a solid foundation, not fleeting trends. Scammers often exploit FOMO, so always be wary of anything that promises quick, easy returns. Anchoring bias: this occurs when we give too much weight to the first piece of information we receive, even if it's irrelevant, and then base subsequent decisions on that anchor. For example, if you've always heard that a certain debt is unmanageable, that belief can become an anchor, making it harder to envision a path to repayment. Your armor: be open-minded and actively seek out diverse perspectives and information. Challenge your initial assumptions. If you're anchored to a negative belief about your debt, seek out success stories or new strategies that offer a different perspective. Don't let old information dictate your new financial reality. Mental accounting: this is our tendency to mentally categorize money into different pots, even when it doesn't make logical sense. You might have money in a low-interest savings account while simultaneously carrying high-interest credit card debt. Rationally, paying off the high-interest debt first is usually the best move, but mentally, those funds are in different buckets. Your armor: adopt a holistic view of your finances. See all your money as one big pool. Regularly review your entire financial picture to ensure your actions are aligned with your overarching goal of debt freedom, regardless of which pot the money is currently in. Prioritize paying down the most expensive debt first, even if it means temporarily depleting a savings pot that isn't earning much interest. Overconfidence bias. This is the tendency to overestimate your abilities and underestimate risks. In debt management, this might look like taking on too much debt, believing you can easily pay it back, or underestimating the impact of an unexpected expense. Your armor: practice humility and realistic self-assessment. Always build in a buffer for unexpected events. Consult with trusted resources or even a financial professional to get an objective perspective on your plans. A healthy dose of caution can prevent significant financial missteps. Beyond understanding individual biases, there are overarching strategies to strengthen your psychological armor. The power of pausing. Before making any significant financial decision, especially one involving spending or taking on new debt, take a deliberate step back. Don't let emotions or impulses dictate your actions. Give yourself time to think rationally, review your budget, and consider the long-term implications. This pause creates a crucial space for conscious decision-making. Do your research. Don't rely on rumors, social media trends, or a single source of information. Actively seek out reliable, diverse information to inform your financial choices. The more informed you are, the less susceptible you'll be to misleading information or emotional appeals. Seek external perspective. If you find yourself struggling to overcome these biases, or if the emotional weight of debt feels overwhelming, don't hesitate to seek professional help. Financial therapists are trained to help you navigate the emotional side of money, while certified financial planners can provide objective, strategic guidance. This isn't a sign of weakness. It's a sign of strength and a commitment to your financial well-being. Building this psychological armor is an ongoing process. It requires self-awareness, consistent effort, and a willingness to challenge your own thinking. But by doing so, you're not just managing your money, you're mastering your mind, paving the way for truly rational and empowering financial decisions. In our next chapter, we'll transition from these powerful mindset shifts to the practical blueprint for your debt repayment journey, helping you create a realistic and effective plan to achieve your financial freedom. Chapter 7: Your Debt Blueprint: Creating a Realistic Plan. We've laid the groundwork. You've committed to stopping new borrowing, cultivated a growth mindset, and armed yourself against psychological biases. Now, it's time to translate that powerful inner work into tangible action. This chapter is all about creating your personalized debt blueprint, a realistic, actionable plan that will guide you step by step towards financial freedom. The very first step in crafting any effective plan is to know your numbers. You can't navigate a journey without a map, and your financial numbers are your map. This means getting a crystal clear view of your income and your expenses. It might feel daunting to look at everything head-on, especially if you've been avoiding it, but this is a crucial act of empowerment. Start by tracking all your income sources: your annual salary, any bonuses, income from side hustles or freelance work, and any benefits you receive. Then, meticulously track every single expense. This isn't about judgment, it's about awareness. You can use simple spreadsheets, dedicated budgeting apps like Mint, or You Need a Budget, INAB, or even a pen and paper if that's your preference. The goal is to see exactly where your money is going. This clear view will reveal where you might be overspending and where opportunities exist to reallocate funds towards debt repayment. Once you have a clear picture of your income and expenses, it's time for budgeting made easy. A budget isn't a straitjacket, it's a tool that gives you control and clarity. It's about understanding where your money is going and finding ways to manage it better. There are several popular methods, and you can choose the one that best fits your personality and lifestyle. The 50/30/20 rule. This simple method allocates 50% of your income to needs, housing, utilities, groceries, 30% to wants, dining out, entertainment, hobbies, and 20% to debt repayment and savings. It's a great starting point for many. Zero-based budgeting. With this method, every dollar is assigned a job. Your income minus your expenses, including debt payments and savings, should equal zero. This ensures every dollar is accounted for and working towards your goals. Regardless of the method you choose, remember that your budget is a living document. You can and should adjust it whenever your financial circumstances change or as you learn more about your spending habits. The key is to be practical and realistic about what you can afford to pay each month towards your debt. Now, with your budget in hand, it's time to choose your debt payoff strategy. This is where the psychology of debt truly comes into play, as the best strategy isn't always purely mathematical, it's often the one you're most likely to stick with. 1. The debt snowball method. This strategy focuses on psychological wins. You list all your debts from the smallest balance to the largest, regardless of interest rate. You pay the minimum on all debts except the smallest one, on which you pay as much as you possibly can. Once that smallest debt is paid off, you take the money you were paying on it and add it to the payment for the next smallest debt. This creates a snowball effect, where your payments grow larger as each debt is eliminated. The rapid succession of paying off small debts provides powerful motivation and keeps you engaged in the process. 2. The debt avalanche method. This strategy is mathematically the most efficient. You list all your debts from the highest interest rate to the lowest. You pay the minimum on all debts except the one with the highest interest rate, on which you pay as much as you possibly can. Once that debt is paid off, you move to the next highest interest rate. This method saves you the most money on interest over time. Which one is right for you? If you need quick wins and motivation to stay on track, the debt snowball might be your best bet. If you're highly disciplined and want to save the most money on interest, the debt avalanche is likely more suitable. The crucial part is to choose a strategy and commit to it. Finally, and perhaps most importantly, stick to the plan. Consistency is the superpower of debt repayment. It might seem daunting initially, but when you start small and think big, every single payment adds up. Every dollar you put towards your debt gets you closer to your goal of being debt-free. Don't let perfection be the enemy of progress. If you have a setback, don't abandon the plan, simply adjust and get back on track. This blueprint is your roadmap. It's designed to give you clarity, control, and confidence. In our next chapter, we'll dive into tackling specific types of debt, providing tailored strategies for each one. Chapter 8, Tackling Specific Debts. You've created your debt blueprint, a powerful roadmap for your journey to financial freedom. You know your numbers, you've chosen a budgeting method, and you've committed to a debt payoff strategy. Now, it's time to get specific. Different types of debt come with their own unique challenges and require tailored approaches. In this chapter, we'll break down how to tackle some of the most common forms of debt, giving you targeted strategies for each. Credit card debt, the high-interest beast. Credit card debt is often the most insidious, primarily due to its high interest rates. Many Americans, especially baby boomers and Gen X, report significant struggles managing this type of debt. The key to conquering credit card debt is a multi-pronged approach. Stop the bleeding. First and foremost, stop using your credit cards for new purchases. This aligns with our "no more borrowing" rule. Prioritize high-interest balances. If you're using the debt avalanche method, your credit cards will likely be at the top of your list due to their high annual percentage rates, APRs. Focus intensely on paying down the card with the highest interest rate first, while making minimum payments on others. Pay more than the minimum payments are designed to keep you in debt longer. Even an extra $20 or $50 above the minimum can significantly reduce the time it takes to pay off your balance and the total interest you'll pay. Responsible use. If you must use a credit card, ensure you can pay off the entire balance every month. Avoid maxing out your cards, as high credit utilization can negatively impact your credit score. Negotiate interest rates. Don't be afraid to call your credit card company and ask for a lower interest rate. Many companies are willing to work with you, especially if you have a good payment history or are struggling. Student loan management. Navigating the labyrinth. Student loans can feel like a lifelong burden, particularly for Gen Z and millennials. However, there are more options available than you might realize. Understand your loan types, differentiate between federal and private loans, as they have different repayment options and protections. Explore repayment plans. Federal student loans offer various income-driven repayment, IDR, plans, which adjust your monthly payment based on your income and family size. The new Repayment Assistance Plan, RAP, for instance, sets monthly payments as a percentage of your income and can significantly reduce long-term debt burdens by eliminating interest accumulation for eligible borrowers. Consider forbearance or deferment. With caution, these options allow you to temporarily pause payments, but interest may still accrue, and the deferred amount often becomes due as a lump sum at the end of the period. Use these only as a last resort in true financial hardship. Minimizing future burden. If you're still in school or considering further education, be aware of new federal loan limits. The Grad Plus loan program, which had no hard borrowing limit, is being eliminated on July 1, 2026, and new caps are in place for graduate and professional loans. This underscores the importance of borrowing only what you truly need. Refinancing student loans. You can refinance federal or private student loans through private lenders, potentially securing a lower interest rate or a different repayment term. However, be aware that refinancing federal loans into private ones means losing federal protections like IDR plans and forgiveness programs. Auto and personal loans, direct paths to repayment. Auto loans and personal loans are typically installment debts with fixed payments and terms. While often less psychologically complex than revolving credit, they still require diligent management. Stick to your payment schedule. Consistency is key. Make your payments on time, every time, to avoid late fees and negative impacts on your credit score. Accelerate payments. If your budget allows, paying extra towards the principal each month can significantly reduce the total interest paid and shorten the loan term. Refinancing auto loans. You can often refinance an auto loan to get a lower interest rate, especially if your credit score has improved since you took out the original loan. This can reduce your monthly payment or the total cost of the loan. Medical debt, the unexpected burden. Medical debt is a significant challenge for many, with 70% of Americans with substantial medical debt reporting difficulty managing it. This type of debt often arises unexpectedly, adding immense stress. Negotiate with providers. Don't be afraid to call the hospital or medical provider and negotiate the bill. Many are willing to offer discounts for upfront payment or set up interest-free payment plans. Check for financial assistance. Hospitals often have financial assistance programs or charity care policies for those who qualify. Review your bill. Scrutinize your medical bill for errors or duplicate charges. Buy now, pay later, BNPL, debt. The hidden trap. BNPL services have exploded in popularity, particularly among Gen Z and millennials, who are often credit skeptical and prefer using debit cards. While seemingly convenient, BNPL can lead to accumulating multiple, smaller debts that are hard to track. Understand it's still debt. Recognize that BNPL is a form of debt, even if it doesn't feel like traditional credit. Track all BNPL payments. These payments can easily slip through the cracks of a budget. Integrate them into your debt blueprint and track them meticulously. Avoid overleveraging. Don't use BNPL for multiple purchases simultaneously, as this can quickly lead to an unmanageable number of small, recurring payments. Prioritize repayment. Treat BNPL payments with the same urgency as any other debt to avoid late fees and potential restrictions on future use. General strategies for all debts, your universal tools. Regardless of the debt type, some universal strategies can help. Negotiate with creditors. If you're struggling, always consider reaching out to your lenders. You may be able to agree on a lower interest rate, a more affordable payment plan, or even a settlement amount. Be polite, explain your situation, and be prepared with your financial information. Increase your income. Many Americans are actively seeking opportunities to boost their earnings to reduce their debt burden. A side hustle, overtime, or even selling unused items can provide extra cash to accelerate your debt payments. Seek professional help. if you feel overwhelmed by debt, or if your efforts aren't yielding results, don't hesitate to seek professional guidance. A certified financial planner, CFP, or a reputable credit counseling agency can provide personalized advice and help you navigate complex situations. Tackling specific debts requires diligence and a tailored approach, but remember, every payment, every negotiation, and every smart decision moves you closer to your ultimate goal. You are actively dismantling those invisible chains, one debt at a time. In our next chapter, we'll shift our focus to what comes after debt, rebuilding your credit and establishing a strong foundation for lasting financial health. Chapter 9: Advanced Debt Management and Optimization. You've diligently worked through your debt blueprint, tackling specific types of debt with targeted strategies. Now, as you gain momentum and confidence, it's time to explore some more advanced tools and techniques that can significantly accelerate your journey to freedom. This chapter focuses on optimizing your debt repayment, leveraging strategies like consolidation, refinancing, and even boosting your income to make your money work harder for you. Debt consolidation, simplifying your path. If you're juggling multiple debts, especially high-interest ones like credit cards, debt consolidation can be a powerful strategy. The idea is simple: you take out a new, larger loan, often with a lower interest rate, to pay off several smaller debts. This leaves you with just one monthly payment, often at a more manageable interest rate, simplifying your financial life and potentially saving you money on interest over time. Pros: simplifies payments, one bill instead of many, potentially lowers your overall interest rate, and can provide a clear end date for your debt. Cons: you're taking on a new loan, and if you're not careful, you could end up with a longer repayment period, or even a higher interest rate if your credit isn't strong. It also doesn't address the underlying spending habits, so there's a risk of accumulating new debt on the old, now empty credit lines. When it's viable, debt consolidation is often a good option if you have multiple high-interest debts, a good credit score, to qualify for a lower interest rate, and a strong commitment to not incur new debt. Refinancing strategies, unlocking better terms. Refinancing involves taking out a new loan to pay off an existing one, typically to secure better terms like a lower interest rate or a more favorable repayment schedule. This is particularly common for larger debts like mortgages, student loans, and auto loans. Mortgage refinancing: many homeowners explore refinancing their mortgage to lower their interest rate, which can significantly reduce monthly payments or the total interest paid over the life of the loan. You might also refinance to shorten your loan term or convert an adjustable-rate mortgage to a fixed rate. However, be mindful of closing costs and fees associated with a new mortgage. Student loan refinancing: you can refinance federal or private student loans through private lenders. This can lead to a lower interest rate, especially if your credit score has improved since you first took out the loans. A crucial caution here: if you refinance federal student loans into a private loan, you will lose valuable federal protections, such as income-driven repayment plans, forbearance options, and potential forgiveness programs. Weigh these benefits carefully against any potential interest savings. Auto loan refinancing. Similar to student loans, you can refinance an auto loan to potentially secure a lower interest rate, which can reduce your monthly payment or the total cost of the loan. This is often beneficial if your credit score has improved since you purchased the vehicle. Pitfalls to watch out for: always read the fine print. Be aware of any fees associated with refinancing, and ensure that a lower monthly payment doesn't come at the cost of extending your loan term significantly, which could mean paying more interest overall. Negotiating with creditors: advocating for yourself. This might sound intimidating, but negotiating with your creditors is a powerful tool, and it's often more effective than you might think. If you're struggling to make payments, or even if you just want to explore better terms, don't hesitate to reach out to your lenders. How to approach them: be polite, explain your situation clearly, and be prepared with your financial information, income, expenses, what you can realistically afford. What to ask for: you might be able to negotiate a lower interest rate, especially on credit cards. You could also ask for a temporary payment plan that reduces your monthly obligation. In some cases, for utility bills or other specific debts, you might be able to set up a more manageable payment schedule. Forbearance/deferment, with caution for student loans or other specific debts, you might be offered forbearance or deferment. While these can temporarily pause your payments, be aware that interest often continues to accrue, and the full amount may be due as a lump sum at the end of the period. Use these options only if absolutely necessary and understand the terms fully. Remember, creditors want to get paid. It's often in their best interest to work with you to find a solution rather than have you default on your debt. Boosting your income, accelerating your payoff. While cutting expenses is vital, increasing your income is another incredibly effective way to accelerate your debt repayment. Many Americans are actively seeking opportunities to boost their earnings to reduce their debt burden, and you can too. Side hustles. Explore opportunities to earn extra money outside your primary job. This could be freelancing, driving for a rideshare service, delivering food, selling crafts, or leveraging a skill you have. Overtime. If your job offers overtime, consider taking on extra hours, even temporarily, to funnel that additional income directly towards your debt. Selling and used items. Decluttering your home can also be a source of quick cash. Sell clothes, electronics, furniture, or anything you no longer need or use. Negotiate a raise. If you've been performing well at your job, consider negotiating a raise. Even a small increase can make a big difference over time when consistently applied to debt. Every extra dollar you bring in and direct towards your debt is a dollar that shortens your journey to freedom. It's a proactive step that puts you firmly in control. By strategically employing debt consolidation, refinancing, negotiating with creditors, and actively boosting your income, you're not just chipping away at your debt, you're optimizing your entire financial landscape. These advanced strategies empower you to take a more aggressive and efficient path towards becoming debt-free. In our next chapter, we'll shift our focus to what comes after debt, rebuilding your credit and establishing a strong foundation for lasting financial health. Chapter 10: Rebuilding Your Credit and Financial Health. You've embarked on a remarkable journey, diligently working through your debt, understanding its psychological grip, and implementing practical strategies to break free. As your debt balances shrink and your financial confidence grows, a new horizon emerges, not just being debt-free, but building a robust, secure financial future. This chapter is about two critical pillars of that future: rebuilding your credit and establishing an emergency fund, your shield against future debt. Understanding and improving your credit score, your financial reputation. Your credit score is essentially your financial reputation. It's a three-digit number, typically ranging from 300 to 850, that lenders use to assess your creditworthiness. A good score, generally considered around 670 to 700 and up, can unlock better interest rates on loans, lower insurance premiums, and even make it easier to rent an apartment or get certain jobs. An excellent score, 800 and over, opens even more doors. So, what influences this crucial number? The key factors include payment history. This is the most significant factor. Consistently paying your bills on time is paramount. Late payments can severely damage your score. Credit utilization. This refers to how much of your available credit you're using. Keeping your credit card balances low relative to your credit limits is vital. Avoid maxing out your cards. Length of credit history. The longer your credit accounts have been open and in good standing, the better. Types of credit. A mix of different credit types, e.g., credit cards, installment loans, can be beneficial. New credit. Applying for too much new credit in a short period can temporarily lower your score. Strategies to improve your credit. Pay bills on time, every time. Set up automatic payments or reminders to ensure you never miss a due date. Reduce debt. As you've been doing, paying down your debts, especially credit card balances, will directly improve your credit utilization and score. Use credit cards responsibly. If you use credit cards, aim to pay off the entire balance each month. If you can't, keep your utilization below 30% of your limit. Check your credit report regularly. You're entitled to a free credit report from each of the 3 major bureaus annually. Review it for errors and dispute any inaccuracies. Limit new credit applications. Only apply for credit when absolutely necessary. Keep old credit cards open, even if you've paid off a credit card. Keeping the account open, and not using it, or using it sparingly and paying it off immediately, can help your credit score by maintaining a longer credit history and higher available credit. The emergency fund, your shield against future debt. As you emerge from debt, the last thing you want is to fall back into it due to an unexpected expense. This is where your emergency fund becomes your ultimate financial armor. It's a dedicated savings account, easily accessible, designed to cover unforeseen costs like a car repair, a medical emergency, or a job loss. The data clearly shows why this is non-negotiable. 55% of Americans fear losing everything if a recession occurs, making emergency savings a top priority. And with over 66% of Americans living paycheck to paycheck, the need for this financial cushion is more urgent than ever. Why an emergency fund is non-negotiable? It prevents you from incurring new debt when life throws a curveball. Instead of reaching for a credit card, you can tap into your savings, maintaining your debt-free status and peace of mind. How much to save? The general recommendation is to save 3 to 6 months' worth of essential living expenses in an easily accessible, separate savings account. This includes rent/mortgage, utilities, groceries, transportation, and insurance. Strategies for building your fund. Automate it. Set up automatic transfers from your checking account to your emergency savings account each payday. Even small, consistent contributions add up quickly. Direct debt payments to savings. Once a debt is paid off, take the money you were previously sending to that creditor and redirect it to your emergency fund. This is a powerful way to build your cushion rapidly. Windfalls. Direct any unexpected income, like tax refunds, bonuses, or gifts, straight into your emergency fund. Cut temporary expenses. Temporarily reduce discretionary spending to boost your savings rate. The peace of mind dividend. Beyond the practical benefits, building an emergency fund offers an invaluable psychological dividend, peace of mind. Knowing you have a financial cushion to fall back on significantly reduces financial stress and anxiety. It allows you to sleep better, focus more clearly, and make decisions from a place of security rather than fear. This emotional security is a direct result of your hard work and commitment, and it's a feeling worth striving for. By diligently rebuilding your credit and establishing a robust emergency fund, you're not just closing the chapter on debt, you're opening a new one filled with financial resilience, confidence, and the freedom to pursue your dreams without the constant burden of worry. In our final chapter, we'll discuss how to sustain this newfound freedom and continue building wealth for the long term. Chapter 11, Sustaining Your Freedom, Long-Term Habits. You've done the hard work. You've confronted your money mindset, disarmed the impulse trap, created your debt blueprint, and diligently tackled each debt. You've rebuilt your credit and established your emergency fund. This is a monumental achievement, and you should feel immense pride in how far you've come. But here's a crucial truth: financial freedom isn't a destination you arrive at and then stop. It's an ongoing journey, a continuous process of learning, adapting, and nurturing healthy habits. This chapter is about sustaining your freedom and building lasting financial well-being. Maintaining a debt-free lifestyle, your new normal. The biggest challenge after becoming debt-free is often preventing new debt from creeping back in. It's easy to fall back into old patterns, especially when the immediate pressure is gone. Your "no more borrowing" rule, which was a temporary commitment, now needs to become a permanent lifestyle choice for discretionary spending. Continue your budgeting practice. Your budget isn't just for debt repayment, it's your tool for financial clarity and control. Keep tracking your income and expenses. Adjust your budget to reflect your new reality, perhaps now allocating more to savings, investments, or experiences you value. Live below your means. This fundamental principle remains your strongest defense against debt. Consistently spend less than you earn, creating a surplus that you can direct towards your financial goals. Prioritize needs over wants. While you can now enjoy more discretionary spending, maintain the discipline of distinguishing between essential needs and desires. Keep the momentum up. Remember the feeling of progress as your debt vanished. Keep that momentum alive by setting new financial goals, whether it's saving for a down payment, investing for retirement, or funding a dream vacation. Every payment, every saving contribution, keeps you moving forward. Continuous financial education, staying ahead of the curve. The financial world is constantly evolving. Economic shifts, new technologies, and policy changes can all impact your personal finances. To sustain your freedom, continuous financial education is more important than ever. Stay informed, keep an eye on broader economic trends, such as inflation and interest rates, and understand how they might affect your financial goals. Understand policy changes, new tax cuts, student loan reforms, and other government policies can significantly impact your bottom line. Stay informed about these changes to leverage them to your advantage. Embrace financial tools. More than 60% of people now use financial apps to track spending, manage debt, and plan investments. Continue to utilize these tools, or explore new ones, to help you stay organized and make informed decisions. Learn about investing. Once debt-free, your focus will naturally shift to wealth building. Educate yourself on long-term investment principles like diversification, dollar-cost averaging, and adopting a long-term perspective to avoid common investing mistakes. You don't need to be an expert, but understanding the basics will empower you. The ongoing journey of financial well-being. Financial health is not a fixed state, it's a dynamic process that intertwines with your overall well-being. Your relationship with money will continue to evolve, and that's perfectly normal. Address the emotional side of money. Continue to be mindful of your emotional responses to money. The rise of financial therapy highlights the growing recognition that financial decisions are deeply intertwined with psychological factors. If old anxieties or new challenges arise, don't hesitate to revisit the psychological tools you've learned or seek professional guidance. Adapt and adjust. Life happens. Your income might change, family circumstances might shift, or unexpected expenses could arise. Be flexible with your financial plan, adapting it as needed without losing sight of your long-term goals. Focus on abundance, not scarcity. Continue to cultivate an abundance mindset. Instead of fearing lack, focus on the opportunities for growth and the positive impact your financial freedom can have on your life and the lives of those around you. Celebrating milestones, acknowledging your progress. Finally, and perhaps most importantly, remember to celebrate your milestones. The journey to financial freedom is long and challenging, and acknowledging your progress is vital for maintaining motivation and reinforcing positive habits. Acknowledge every step, whether it's paying off your first credit card, reaching a specific savings goal, or simply sticking to your budget for a month. Take time to recognize your achievements. Reward yourself. Responsibly plan small, non-debt incurring rewards for reaching significant milestones. This could be a nice meal out, a small experience, or a purchase you've saved up for. These rewards reinforce positive behavior and make the journey more enjoyable. Reflect on your transformation, look back at where you started and truly appreciate how far you've come. The sense of accomplishment that comes from seeing your debt vanish is, as many have found, truly priceless. You have transformed your relationship with money. You've broken free from the invisible chains of debt and built a foundation for lasting financial well-being. This is your empowered financial future, and it's yours to continue building, one smart decision and one healthy habit at a time. In our final conclusion, we'll recap your incredible transformation and look ahead to the limitless possibilities that await you. Conclusion: your empowered financial future. We've reached the end of our journey together, but in truth, this is just the beginning of yours. You picked up this audiobook, perhaps feeling the heavy, invisible chains of debt, the silent burden of financial stress, or the nagging anxiety that money often brings. You dared to look beyond the numbers, to understand the profound psychological landscape of debt, and to confront the limiting beliefs and biases that may have held you back. Think back to where you started. You learned that debt isn't just a financial problem, it's a mental and emotional one, impacting your peace, your health, and your relationships. We unmasked the insidious influence of biases like loss aversion, present bias, and FOMO, understanding why we spend when we shouldn't, and how these psychological traps can keep us stuck. Then, we began the powerful work of breaking free. You made the non-negotiable commitment to stop new borrowing, a declaration of independence that sets the stage for all future progress. You embraced a growth mindset, believing in your inherent ability to improve your financial situation and setting clear, inspiring goals for your future. You built your psychological armor, learning to recognize and counteract those biases, transforming fear into empowered decision-making. And then, we moved to the practical. You crafted your personalized debt blueprint, a realistic plan to tackle every dollar owed, whether through the debt snowball or debt avalanche method. We dove into specific strategies for conquering credit card debt, navigating the labyrinth of student loans, managing auto and personal loans, and even addressing unexpected medical bills and the growing challenge of buy now, pay later services. You learned how to optimize your repayment through consolidation, refinancing, and even boosting your income. Finally, we looked beyond debt, focusing on building a secure financial future. You now understand the vital importance of rebuilding your credit, transforming your financial reputation, and establishing that crucial emergency fund, your shield against future financial setbacks and a powerful source of peace of mind. This is your transformation. You are no longer a passive recipient of your financial circumstances. You are an active, empowered participant, equipped with both the psychological insights and the practical tools to control your financial destiny. The freedom you've gained isn't just about zero balances, it's about the freedom from worry, the freedom to make choices aligned with your values, and the freedom to pursue your dreams without the constant burden of financial stress. The journey continues, of course. Financial well-being is an ongoing process of learning, adapting, and nurturing healthy habits. But you now have the foundation, the mindset, and the blueprint to sustain your freedom for the long term. Continue to educate yourself, remain adaptable to economic shifts, and always celebrate your milestones. You have the power. You always did. Now, go forth and live your empowered financial future. The world awaits the confident, debt-free you.
I hope you enjoyed this video. If you do, please don't forget to like, comment and share this video. Also don't forget to subscribe the channel and press the bell icon, so that you don't miss out the next video. For now, you can continue with the next video or can go through the complete playlist provided here.